Good morning to our wonderful audience, and thank you again for joining the third day of the Offshore Investment Managers webinar. It's great to have you all back with us again, and thank you for your continued support. On screen now is the agenda for the day, where we will cover a lot of ground again on global macro, value, quality, global property and emerging markets, and a bit on global bonds. All the presentations, as you know, we will share on the Boutique Managers website, as well as the recordings of all 3 days. Welcome to post your questions in the Q&A bubble as we progress. We will take a couple of questions after each presentation. With the Fed not in a hurry to adjust their policy stance and bond yields continuing to climb, can stocks stand on their own earnings, and can growth in earnings continue? The UK and Europe have more opportunity for rate cuts that might be the catalyst for improved growth outside the US. Or do we follow the money of Musk and the oligarchs surrounding Trump? Is there merit in the conspiracy theorists' chaos theory? How should we position our clients' global component in portfolios, and how do we make sense of all these events? Getting right into the meat of things, we're kicking off with global equity, and we are joined by Andreas van der Horst from Manger Asset Management. Good morning, Andreas. How are you doing?
Eugene, good morning. Great to be here again. Thank you for the opportunity. We always appreciate being up first, and good morning to our participants. Lovely to have you here and to share our ideas and thoughts with you this morning. So just a brief overview. Let's kick off with some of our performance figures, then we'll chat about what we do and how we do it at Manger, and then we'll devote the rest of the prezo to the very important topics of diversification, valuation, and sell discipline. People don't always talk about those topics. So let's just take stock of how we've done. These are now the numbers through the books to the end of Jan. 1, 2, 3, 4, we're well ahead of the CISA Global Equity Peer Group. And in fact, as you can see, we rank top quartile over all periods. On a 1-year basis, we've delivered 21%. On a 2-year, 3-year, and 4-year CAGR basis, we've done 28, 21, and 16%. And all of this is after management fees. Next slide, please. Okay, our pleasing performance numbers aside, let's just focus and pause for a moment on what we want to achieve. So we want to balance 2 central elements: deliver an above benchmark hard currency return over the medium to long term, and do that by managing risk. We want to avoid the permanent loss of capital. We're very clear about the task at hand for us. And we're clear about it because we want to focus every single day on our investment process and, crucially, the improvement of our investment process. Next slide, please. How do we deliver a repeatable benchmark-beating performance? We take 3 steps. We search for the best companies in the world. To be clear, not fair companies at wonderful prices or the next best speculative thing. We are looking for companies who win and will continue to win. And when we find them, we buy these businesses at the right price. Valuation, as we'll discuss later on, matters tremendously for exceptional long-term returns. And lastly, we're super patient. We let our businesses compound. And the proof is in the pudding. Our portfolio turnover is low. It's about 10% a year. If I can quote Charlie Munger, the big money is not in the buying and in the selling, but in the waiting. We buy the best companies, we buy them at the right price, and we let them compound. It's really that simple, and it is that hard. Next slide, please. But delivering a benchmark-beating performance does not happen by itself. When we talk about these great businesses that we own, what are we looking for? We are looking for businesses with a moat. As Warren Buffett said, we want to find a business with a wide and long-lasting moat around it, that protects a terrific economic castle with an honest lord in charge of the castle. And we want sharks in the moat, very, very hungry sharks to keep the competition away. So what are some of the attributes of these great moat businesses that we seek to own? For starters, they must have durable competitive advantage. When we think about this, we think about strong brands, technology, IP, large installed base, maybe regulatory barriers, annuity revenue. All of these things come to mind when we think about moats. But having great moats is not good enough if your business is not run by exceptional people. We want incredibly smart management that is commercially shrewd, sorry, tongue twister there, and above all, honest. Now, finding all of those things in one person is almost impossible, never mind a management team. But a great business must also have great numbers. Otherwise, what is it? It's nothing more than a great story. So we look for those numbers. They must be structurally wide margins right down the income statement. But margins are not just the only measure of profit. For shareholders, the question we are trying to answer is, how hard is our capital working? What is each dollar invested in that business producing, and what is it doing? And that is the most important question we are trying to answer. Our businesses need to deliver really high return on invested capital. And that return on invested capital must be well above the cost of that capital. That is our measure of intrinsic profitability. But it doesn't stop there. We need growth, organic growth. Our companies must be able to invest, or at least reinvest some or all of their profits in their own business to produce an even bigger stream of profits and free cash in the years to come. Now, this snowballing of that free cash on a per share basis, because that's what we own, that really drives shareholder value and wealth for our investors over time. When we find these businesses, what must we do? We must buy them and give them time. We want to build substantial wealth, but that does not happen overnight. Wealth is the reward for your patience. Lastly, we're not perfect, and nobody's perfect, and nobody knows the future. So if we make a mistake, we cut. We don't sit around hoping that our bad investment idea will turn good anytime soon. Next slide, please. Let's take a look at how our quality growth-focused portfolio played out last year. On the left, you will see the top 10 return contributors for the equity. On the right, you will see our portfolio. All the usual suspects are there: NVIDIA, Amazon, Apple, Facebook, Tesla, and Google. What is not there is Microsoft. But what a story the Mag 7 was. And in fact, most people will tell you that you cannot beat the benchmark without the Mag 7. It's just not true. On a one-year basis, 32% of stocks beat the equity. And that is a benchmark that consists of 2,650 stocks. So 850 stocks did the job of beating the benchmark. That's 1 in 3 odds. Those are good odds. Even on a 3-year CAGR basis, where the hurdle rate for the equity was 8.4% in dollars, 31% of the stocks did the job. So also very good odds for a stock picker. But when you look at our top 10, we beat the benchmark and we only had 2 of the top set of the Mag 7. So what is happening here? It really comes down to philosophy and a repeatable process. Outside of Facebook and Google, we did the job of beating the benchmark by owning medical imaging, data center networking, running shoes, online education, robotic surgery, luxury goods, accommodation bookings, and aircraft engine parts. Yet, the common thread through all of our businesses is profitable capital allocation, exceptional management teams, and secular growth opportunity that is deeply profitable. Our approach truly delivers diversification. Next slide, please. Let's compare our portfolio to the market. On the left, you'll see the market split up by sector, and on the right, you'll see our portfolio. The key takeaway from this slide is that we own a collection of businesses in desirable sectors where the moats are simply wider, where the businesses are growing faster, they're doing it more profitably, and they're doing it with less shareholder capital. Practically, our businesses have faster growth at higher levels of intrinsic profitability in the market. And that is what matters when you try to beat the benchmark long term. Although we are skewed to technology and consumer-facing businesses and healthcare, our portfolio nevertheless delivers diversification. Next slide, please. Valuation is a critical component of the work we do. We don't just pay any price for a quality business. For us, valuation is fundamentally determined by the interaction of the level of excess profits generated by our businesses, the ability of that company to reinvest those profits into future growth, and then the trajectory and the duration of that future growth. In other words, how profitable, how quickly, and for how long are our businesses growing? And that is a crucial thing to understand when you approach valuation. Once we've given our best crack at this, we are able to figure out how much we ought to pay for this so that we can still deliver an above benchmark return after fees. Now, it is widely accepted and common cause that a quality strategy typically delivers a portfolio with very high multiples relative to the market. In a certain sense, that's true. And the reason for this is, if I can use the analogy, the same house in a good neighborhood ought to cost more than the same house in a bad neighborhood. So you'd expect that from a quality portfolio. Yet, in our case, for our quality portfolio, we believe it's attractively valued. The chart on your screen shows the median forward PE for the market in gray and the median forward PE for our portfolio in red over the last 10 years to the end of January. Today, our portfolio is attractively priced relative to the market. During COVID in 21, valuations literally blew out. Yet, we performed and continue to perform as the valuation gap between our portfolio and the market narrows. As things stand, we believe we are well set up to deliver for our clients. Next slide, please. Let's talk about one last thing and all the things that you have to do to deliver an above benchmark performance. Buying is easy, selling is hard. As I always say to my colleagues, bad is the enemy of good, which is why you need to be decisive in cutting your losers. We sell on 3 occasions. We call them A, B, or C decision. A is when our ongoing fundamental research and investigative inquiry in the stock that we already own points to risks in that company and potential limitations to our original investment case. In other words, we uncover a potential flaw. We sell. No questions asked. B is where we own a great business. It meets our criteria. It meets all the aspects of our process philosophy, but then something subsequently changed. For example, the company announces an outrageous acquisition, which points to poor capital allocation. Something unexpected happened. We sell immediately. And C is where we find a better investment return opportunity relative to our portfolio and relative to the market. We're going to send somebody packing to make space for a better holding. That's just how life goes. But ultimately, you can evaluate whether your process works. On the right, the table presents all our disposals since the launch of our fund. At the top, you'll see Electronic Arts. They make computer games. We sold this stock 30 months ago. This was now an A-type sell decision. Since the disposal, the stock has fallen 8%, and our portfolio has gone up 64%. So the relative gap is 72%. So it's a good thing that we sold this stock, because if we owned it, it would have been a drag on our performance. At the bottom, you'll see Visa. Since the disposal, Visa did 18%, but our fund only did 13%. Arguably, we would have been better off holding Visa, but 5% return difference over 5 months is neither here nor there. So that's one of those too hard to call or close to call type situation. But Visa was a type C sale. In other words, we found something else that we liked more. At the time, we owned both MasterCard and Visa. We sold Visa and replaced it with Stride, an online education business in the US, which delivered in 5 months in US dollars, 61% for our clients. So that's now what we call a super sub. One last comment when we look at this table. crucially, we did not make any decisions that fell into the bad decision category or a mistake. In other words, a decision that left money on the table for our investors. Our investors can take comfort in the fact that our sell discipline on balance works. Selling well also matters tremendously for long-term performance. Next slide, please. Let's wrap it up. We invest in great companies and we're driven to avoid bad ones. We might pay a bit more for exceptional quality businesses, but we value them for what they are really worth. We believe we offer a compelling opportunity to our co-investors at a fair price. Eugene, thank you very much.
Very good results at very attractive fees indeed. Andreas, thank you very much for that. I don't see any open questions from the audience, but from my side, very quickly, the Manger BCI Global Equity Feeder Fund feeds into your Global Equity Fund. The ZAR-denominated fund, the benchmark is the SSR category, but as you illustrated as well with your global fund, you've got MSCI ACWI as the benchmark. And as we all know, unlike the MSCI World Index, the ACWI includes emerging markets. Was that purposefully done to include the ACWI or to include the benchmark where there's emerging markets as well and not just developed markets?
It's a good question. From a technical point of view, there's one answer, and that is that ACWI is probably sort of the broadest gauge of global markets. And so that's most appropriate for our retail and our institutional clients. That's the one point. But the second point is we want to expose ourselves to the broadest opportunity set. And so right now, close to 70% of our portfolio is in equities listed in the US, but a time will come where there are lots more quality, highly profitable growing business in emerging markets, and we'll go there. To give you some examples, we own Pinduoduo in China, we own Tencent, and recently we bought Nubank, which is a Brazilian bank, but it is listed in New York. So we certainly get our fair share of emerging market exposure. And the third point I would just make is that while we haven't showed it in this presentation, when you look at the underlying revenue of where our companies earn their revenue, it is actually our portfolio's revenue is very well matched to the revenue of the ACWI. So it's actually a very well diversified portfolio also from a geographic point of view.
Doesn't necessarily mean that you have to buy specifically into EMs to actually gain access to those earnings. 70% focused on the US. Where do you shoot in the US at the moment? Because your valuations in the fund, obviously, if you just look at your forward Ps at the moment, very different to the MSCI or the S&P, which some would consider as expensive, but looking at your PEs, almost trading at fair value. Where do you shoot in the US at the moment? Do you deliberately aim towards more mid-cap type stocks, or does it rather actually just speak to your investment philosophy and how you find stocks?
Look, we're bottom-up stock pickers, so we're agnostic from that point of view. Just for peace of mind, we've got 3 stocks that are out of our 38 stocks that are under $10 billion, and the majority are probably $100 billion market caps plus. The US is a very big place, and those numbers are unthinkable for us as South Africans. So we really don't have much in the line of what is mid-cap and small cap. That's the first point I'd make. The second point is our process is able to unearth businesses that have high levels of intrinsic profitability and growth, and where that growth is accelerating. So when you think about something like Arista Networks, which is one of our top 3 holdings, it was on nobody's radar 3, 4, 5 years ago, yet we were able to find it. You think about Prometheus, you know, these things were just not on anybody's radar. Deckers, Hoka, Deckers, these things were just not. So our process unearths that, which uniquely positions us.
Very interesting indeed. The question from the audience, does a wide moat equals a monopoly? If so, how does ESG-centric ease this?
Wide moats don't always denote monopoly. Sorry, yeah?
No, continue. Sorry.
It's really about you know, how those businesses operate in terms of always remaining very capital rich, remaining very very cash flow flush and being able to fix any mistakes. So that is a first point. So it doesn't necessarily mean that it's a mode business. And the second thing, in terms of our ESG inquiry, it's really directed at the sustainability of the business and the governance questions that ultimately drive how those companies interact with their stakeholders and the communities in which they operate. So you find that our businesses tend to have very good ESG just by the nature of how they run, how they've come into being, and how they operate.
What I find very attractive is, other than a good performance record, especially for asset aggregators, is attractive fees on the fund as well, because it won't chase your overall TIC into the sky. So very interesting indeed. How do you manage to keep that TIC so low?
Well, you can see low portfolio turnover is one of them. So if you don't turn your portfolio, then you keep the fee at least the TER super low. And then the second thing is that we believe we're very fairly priced for what we do. We don't want to stand in the way of any investor, big or small, whether it's $1 billion pension fund or whether it's somebody with only 5,000 Rand to invest in their journey to grow their wealth. So there's alignment of those values, which is why the fees are what they are. And fees, lastly, matter tremendously in terms of long-term performance. We believe anything that takes away from that performance must be tightly and carefully managed.
Question from the audience: how does the fund perform in down markets? Companies like Arista feel like growth companies and are quite volatile. What is the fund beta?
The fund beta on an ex-post basis is 1.2. But there's been quite a lot of excitement in January with DeepSense, and so that anything that has kind of like touched AI or data centers or anything like that has taken a smack. Quite frankly, Arista was up at $130. I think it's now at 117 or something after taking a big hit. What is interesting is that in our portfolio management process, one feels these things far more like, oh, all these AI stocks, they've collapsed and fallen. But our AUM has remained flat with no flows, let's say, in the period of January. And so at a portfolio management and portfolio construction level, the portfolio is doing what it's meant to be doing. Some things are volatile, but other things are going up while other things are going down. And over time, we are delivering our outperformance. So I think that's really where the art and science of portfolio management comes in.
Andreas, very concise as usual. Thank you for your time this morning. There's still an open question from Dean. We're going to circulate that question through to you, and we can get a response from your side as well. All we have time for at the moment. Again, thank you so much for joining us. Always a bit rushed, but a lot of info packed in your presentation. Thank you very much.
Thank you very much. You're most welcome. Thank you for listening.
Thank you. Continuing with global property, which remains extremely topical. It was a strong performer in parts of 2024, and there were some really big numbers coming through. But the market gave up a lot of this over the past month or two. Is there still an asset class to consider going forward, and why? With that, it's my pleasure to welcome a very familiar expert on property, founder of Retrade Global, Greg Rawlins. Good morning, Greg. How are you?
Eugene, I'm fine, thank you, and good morning to the viewers.
If I look at the numbers on global property, it makes me wonder. We all know that it's tied to a rate cutting cycle. Valuations on property is still immensely attractive. Towards the end of last year, we had a nice discussion with you and a panel from all over the world, property experts. There was a very strong case to be made on property. Is that still the case, Greg?
Very much so, Eugene, even better. And I will be addressing the actual prospects and what happened particularly in Q4 and what the next year, no, 2025 looks like.
Yeah. Greg, if you can maybe just your slides, put it in, go to display settings again, just full presentation mode. We can see the notes.
Okay, I'll do that. Is that better?
Yeah, swap.
Yeah.
Okay, got it.
Yeah.
Thank you.
Perfect.
Okay.
Thanks, Greg.
So, Eugene, I'd like to start off by complimenting my peer in the global property sector who presented in this offshore investment webinar series in January. And he built up a compelling case for global property. And I just want to take out some of the highlights that caught my attention. Firstly, he noted that global real estate is a story of choice and specialization, which is a message that we've been articulating over many years as this choice continues to grow. And unlike other property, many REITs in many other countries, the US is leading the charge to specialization. If you just have one particular sector, and the management must focus on that, and that helps us as active managers. He also went on to highlight that the high occupancies across most sector augur well for the performance, other than most of the offices, and noted that global REITs loan to value is an average of 35%. And this will be much lower if you select the better quality REITs to include in your portfolio. It's somewhere between 25 and 30%, which is very attractive in this high interest rate environment. And should interest rates decline, it'll augur well again for good performance. And finally, he noted that they are attractively priced, as you mentioned in your opening, and they're priced at an average of 9.3% discount to the net asset value. So what I would like to do is build up on that note or that presentation that my peer put forward a few weeks ago, by taking a relatively broad view of what the market looks like. And these observations are also pertinent to general equities. And I quote Tavis McCourt, the institutional equity strategist of Raymond James, where he observed that most forecasts often fall short. And in the past 7 of 9 years, a primary driver of equity returns, of course, which is REITs are, was entirely unforeseeable just a year prior. So the theme was, I'll be reticent to actually do forecasts. It's just the way of the world at this point in time. And there's always unknown unknowns. He went on, he didn't call them black swan events, but he rather called them unknowns, and I'll list in the next slide what he is referring to. But just recently, in his presentations in November and December, he noted a known unknown, and that AI fatigue may rise. Those new industries, we've seen it over the decades, new industries grow rapidly. Companies that are the initiators haven't got more competition, but as their earnings rise and their prominence rise, it does attract competition. And just recently, we saw the disruption brought about by simply a rumor or an observation that DeepSeek had found a cheaper way to run AI. It has to be tested, and but in the time being, it caused a significant decline in early January. Maybe by this time next year, we'll be looking back in January 25 as the start of a potential slowdown or market rotation. The big question, as you pointed out, is could it be a disruptive rotation? So far, it hasn't, but that just really, I just want to focus on forecasting. He was talking about AI fatigue. Could it have already started 1 or 2 months later after his presentation that he did in late November? And here he's extracted and supporting his view that annual forecasts often fall short. And he highlighted annual events that were unknown unknowns in the year before. And what we did is we've tracked on the right-hand side, we've tracked the S&P reaction to these unknown events. And in these years that we've highlighted, it's a reaction that you'd expect. For instance, in 2017, when Trump was able to reduce the corporate tax rate, the S&P acted very favorably. The next year, with the China trade war, it acted as expected, it went down. However, have a look at 2020 and 2023. There was two events that you'd expect the market to actually decline, but overall it actually increased. So not only do we have this inherent volatility brought about by the dissemination of information and data very quickly, we're just going to have to live with this. It's going to be momentum driven. We also have the unknown unknowns, and then we have the UMP effect. Yep, the Trump effect. We have Trump bumps and Trump slumps in October, November. I would call that or see that as a Trump-induced bump. And then in December, where he really got into his tariffs rhetoric, it was a slump, together with, of course, the inflation information. But this is what we are dealing with, and I would like to run through how we at Reitway are addressing this. Obviously, and Eugene, you made the observation that property is very tied to the interest rate cycle. I'd like to put forward a view and an argument that questions this, but here is the US 10-year yield, which is effectively the risk-free rate for 73% of our portfolio, as it makes up 73% of the market capitalization of REITs. And here's the global property index. If we combine the two together, you can see a near perfect inverted behavior and performance of global property relative to the US 10-year. When the 10-year yield increases, the global property decreases. So it may support the view that there's a strong correlation. But what Tavis McCourt went on to note is that the generalist view all REITs are cyclical, and that then he pointed out, however, index measures obscure nuances at a disaggregated level, and particularly in property, there's a significant divergence in performance within global property across regions and subsectors. Ultimately, there's a notable disparity between winners and losers. So how do we as active managers react to this and address this and mitigate the inherent volatility and the fact that, and the message that we are putting forward is that there is a notable disparity in our sector between the winners and losers? Well, we overweight the sectors that are better positioned to weather economic uncertainty, and make no mistake, we're going to have a high degree of uncertainty over the next 4 years, particularly with Trump. But it isn't all negative. We'll have Trump bumps and we'll have Trump-induced slumps over this period. So we are continue to increase our weighting and our overweighting to non-cyclical REIT like data centers, where there's just insatiable demand driven by data storage and data processing requirements. But another factor that supports data centers is that there's now a growing question about power. And if you've got a data center with a reliable power, you have got pricing power. Excuse the pun, but effectively you are investing in and we are focusing on the pick and shovels of artificial intelligence. So even if earnings growth declines for the or starts leveling off for the likes of NVIDIA over time, which is most likely going to happen, it's still going to create significant demand for data storage and data processing. Similarly, healthcare and communication towers have really good earnings visibility, and they are non-cyclical. Notwithstanding a rising interest rate, there's still a demand for retirement homes and healthcare and medical offices, which are generating earnings, positive and real earnings, despite a rising interest rate environment, and even if the economies slow down, which at this point in time in the US is not looking it's going to happen. So let's have a look at, as we mentioned, a non-cyclical stock. This is a data center REIT, Digital Realty relative to the 10-year yield. And if you can cast your mind back to the original slide where we compared the index relative to the 10-year, it was a near perfect inverted behavior. I would say I'm safe in saying that this is contrary to that, and it's a non-cyclical stock. And together with other data center REITs and other, incidentally, industrial REITs that are increasing their exposure to data center properties, we are getting more and more opportunities to increase our exposure to this non-cyclical sector that is growing in stature relative to the overall market capitalization. And what is driving this? Well, obviously, it's artificial intelligence, and I just want to focus on the inner image of this. Not only is it data storage, but don't forget is that the processing needs are also stored offsite. And over the years, we have been showing images of data centers where we've got banks of processors anywhere between 1 and 4 meters high, stretching over 50 to 100 meters. And these all have to be located in a property, and as well as the obvious one is that data storage equipment as well. So these are artificial intelligence is the current driver. But have a look at the top left-hand side. Autonomous vehicles are only just getting going. Look at the bottom right-hand side. Another potential and significant driver is virtual reality. So we can, with as much as I'm reticent to forecast further than a year ahead, it's safe to say that demand for data center properties for the next 3 years looks pretty secure and augurs well for this type and this REIT sector. Similarly, here is Welltower. It is a healthcare REIT. And again, I ask you to cast your mind back to where we compared the global property index to its performance relative to the 10-year. It was near perfect inverted behavior. Whereas here you can see Welltower has delivered a performance credible performance irrespective of the interest and economic environment. It certainly fits the category of a non-cyclical stock, and we have got other healthcare opportunities that we are increasing our exposure to in the portfolio. However, it's not all non-cyclical stocks. There is also attractive cyclical REITs driven by secular growth. I must emphasize, it's our view that the US economy continues to grow, and the industrial sector hasn't been a star performer over the last 2 years, albeit that the 7 years prior to that, we saw spectacular performance, particularly during the COVID era. and we have started increasing our exposure to that on the back of expected economic growth to the industrial sector, or logistics as we prefer to identify it. And it may surprise you that we are starting to increase our exposure to office, which we have had little or no exposure for the last 4 to 5 years. But it's very particular. It is to A-grade offices that have got exposure to New York, which has got a large financial sector, and the employees are demanding that their employees come to work 5 days a week. And however, to keep them there, most employees want an A-grade experience, and we've identified REITs with exposure to the A-grade and upper B-grade sector in New York, and to a lesser degree, but in the Sun Belt and Florida, there's also increasing opportunities evolving and starting to come to the fore in the office sector. But I must stress, it is secular, and if it does slow down, we'll be out quite quickly. Then if we get to the performance and the earnings growth, I draw your attention to the column on the right-hand side. This is the forecast 2025 funds from operations of just a selection of REITs in our portfolio. There's others that are also expected to deliver a stellar performance. And I just want to observe that when a REIT manager puts forward a 12-month forecast, invariably it's conservative and it is very liable, because remember, we are looking at rental contracts. I draw your attention to Prologis, which is the largest industrial REIT, is expected to deliver 6.5% FFO in this calendar year. Welltower, we've mentioned already, incredible 11%. Equinix, just a little bit further down, is another data center REIT of 12.82%. But as you can see from this list of REITs making up our portfolio, there's many more better performers. They are all expected to deliver a real return exceeding the current CPI of approximately 2.5%. So that is the earnings, but let's have a look at the actual picture. We've been highlighting this performance, this actual performance from the fateful early 2022, when interest rates increased significantly on the back of inflation, and there was a significant decline of global property and a long sideways movement. And during the course of the latter part of 2023 and the whole of 2024, we were putting forward to our clients and investors is that the selected sectors that are delivering real returns and really attractive returns relative to the inflation rate. And we expressed some relief when in August and September, it eventually broke out of this trading range, probably on the back of a Trump bump. But unfortunately, and to our disappointment, Trump really got involved with his tariff rhetoric, and the market pulled back during the course of December. We've noted that it started to recover of late, and it's my view that the market is starting to understand that Trump is negotiating like any business person, going in high and has his target level, and will settle at a result that is better than the current position, and already have noted that he's pulled back the pressure on Canada and Mexico and I'm sure something will come out that is mutually beneficial. However, there's no doubt that the US will be better off than it is at this point in time. So to answer your question, things haven't changed. If anything, it's just a better opportunity, even better opportunity to get into, to increase your exposure to global property on the back of selected sectors delivering absolutely stellar growth, real growth in the near future. Thank you.
Greg, thank you very much for that, and very insightful, the holdings or non-cyclical stocks that you hold in the portfolio. Maybe just one question, and look, we've always made the case of property being a good diversifier in the portfolio. You know, as uncertainty increased globally with Trump shenanigans, all talks about more diversification in portfolios. And it's a lot of what we're unpacking in these kind of sessions. But maybe just in general, is REITs more or less sensitive to market sentiment as opposed to global equity?
Eugene, I have to give a bifurcated yes and no answer to that. And I go back to, again, cyclical and non-cyclical stocks. And then the cyclical stocks that are sensitive to growth if it does come to the fore. The reason why we've got to look at the cyclical stocks is they're becoming more and more prominent and a larger and larger component of the global property index. It was quite frustrating to see all this phenomenal growth, for instance, in data centers, but they up until about a year, 2 years ago, it only made up 7%, 8% of the market capitalization. And the giant was, of course, the industrial sector, and retail was even larger. By the way, retail is making a comeback as well. But let's just go back to towers, healthcare, and of course, the data centers. By the end of 2025, 2026, between those three, they're already almost the dominant sectors, and they are going to be, and I wouldn't be surprised if at the end of 26, data centers and other companies that are investing in, because there is some REITs in the industrial sector that are using some of their properties for data centers. So the exposure to data centers, I wouldn't be surprised at the end of 2026 will be the dominant sector and will be unseating, for instance, industrial. I just go back again, those three sectors alone are just carry on irrespective of the economic conditions, irrespective of the interest rate conditions. On the other hand, I was toying with putting up a slide of one retail, a strip center mall, and it literally tracks the global property index to the T. No dispersion. I must emphasize at this point in time, there's a significant dispersion either side of the global property index. It will change as these non-cyclical stocks become more and more prominent. So yes, there is those that are very interest rate sensitive, significantly interest rate sensitive and economic condition sensitive, and then these ones that I've highlighted, and we are using that to increase our exposure in our portfolio.
Definitely true that a lot of fundamentals will drive returns going forward. And as you rightfully pointed out, a lot of these stocks, non-cyclical, which you hold in the REIT by BCI Global Property Fund, which are on most platforms, and indeed something you still consider. Greg, again, thank you very much for your time this morning. It's always great to have you with us and for the update on global property and REIT thinking. Thank you so much.
Our pleasure. Thank you.
Right, we are continuing with global bonds. On day one, Paul from New Road made a strong case for global bonds in multi-asset portfolios. But some may argue that bond yields may increase further or from this point onwards, and that the risk premia in US increase with higher or growing uncertainty with Trump's shenanigans and trade wars and all this nonsense. But is this really the case for global bonds? It's therefore great to welcome Fanil Tigera from Balondolozi Investment Services to have a more in-depth look at global bonds and the global funds. Fanil, very good to have you with us this morning. Good morning.
Morning, Eugene. Thank you very much, and morning to the rest of the participants who've joined us today. Thank you.
Fanil, before we dive right into global bonds and the opportunity set there, I mean, since we last spoke, you've expanded your product range. It would be great, just for the audience, if you can give us a brief update on the business, and then we can get into the meat of things on bonds.
Thank you, Eugene. We can start now. You'll see that in our first slide, we've got a business update. Next slide, please. We'll just touch on our business update. We were founded in 2010 by Pedro Samuel, and we are a quantitative investment house. And in our approach, we always try to combine the top down with the bottom up in our quantitative modeling. And with the rise of ESG, we then use ESG as a screen to see the eligible investments in our portfolios, either on the investments that we can upweight or underweight, or investments that we ignore altogether. Then in terms of our AUM, we are, as at the end of January 2025, we're at just over 12 billion. Then in terms of our strategies, there are three broad strategies: multi-asset, equities, and fixed income. And you'll see that in our pie chart there, more than 50% of our assets or strategies or AUM is under fixed income. So that includes the global bond strategy that we are going to talk of today. Then in terms of we signatories to the UNP Principles of Responsible Investment, and also the Code 2 of CRISA. We involved in the community we are based in Alexandra Education Committee. Then we also provide mentoring and career support together with the graduate program that has been able to see quite a number of graduates being trained there. So over the past quarter and quarter four last year, we've launched 3 products, adding to our global BCI bond fund. We've added an absolute return fund, an income fund, and we also looking at global equities to be part of that suite of products. So just before I continue, I just wanted to touch on our philosophy in the next slide, where we also just break down on the way we use our quants. Predominantly is macroeconomic analysis, where we look at inflation and economic growth expectations. That's our top down. We also look at the relationships fundamentally, obviously trying to look at the earnings and balance sheets. We also look at the sentiment in the market and looking for turning points if there's the extreme pricing in the market. So we combine the top down and the bottom up to be able to weigh in our positions. And like I said before, we use the ESG screen to be able to see or to narrow our investment universe depending on the requirements of the investor. So for today, we're going to talk about bonds, and we just thought we'll start touching on the universe, just the size of the universe. Then after we look at the universe, we then just go through a few slides to look at the revenue drivers. Then we'll go on to how we then, as Balondolozi, take the opportunities that we see in the markets. So you'll find that as at the end of 2023, that diagram just shows the sizes of markets in dollars, and that includes a notional outstanding. That's the size of derivatives that in the market. So you see that rates market constitute just below 70% of the total trades that we see in the market. You'd have expected equities to be bigger, but one thing that we've seen is that because of the mature pension funds around the world, they play a lot in fixed income, maybe more than what we would see in South Africa. Then followed by the rates market, including the bonds that we're going to talk of today. You'll see that equities are just under 20% of the market. Then credit, FX, money market, commodities, digital assets, and alternatives. So the bond market is quite huge. With the physical or the universe that we play in is about 130 trillion, and you'll see that the total universe is 1 quadrillion. It's 1,000 trillion there. So it's one of the markets that's big. But obviously the determinants of the market are a bit different from equities. In the fixed income global markets, one who gets upweighted is the one who issues or borrows more, whereas in equities, the one who produces the earnings tends to get the higher market caps there. So that's one aspect of the market that obviously brings complexities to the analysis. But for today, we'll go on to the next slide just to focus on the market that we play in, with the index that we track or that we use for investment decision making is the Bloomberg Global Aggregate Index, which obviously in our case it covers the investment grade bonds. That's the BBB minus or better in terms of rating, and it covers 27 markets or currencies. Predominantly, like you see in equities, you find that there the US sort of dominates. We've seen the charts that come through. Then in terms of the size of that market, so it's estimated to be just over 130 trillion. So that's sovereign, graded, and above, and investment grade. And the bulk of the issues that we look at is treasuries. That's just below 45%. The next best is the mortgage-based securities, the pass-through, and those are guaranteed again by the US. And you've got corporates, industrials that are also just below 15% as part of the universe. You see financials just constitute about 6% in terms of issuance or in terms of the weighting within the index. Then if you look at the maturity profile, again, most of the issues are around 7 to 10 maturities, and then they are spread uniformly. Once you get beyond the 15-year mark, you'll see that issuance sort of falls off. Then in terms of credit ratings, predominantly it's AA rated credit ratings, and not much of AAA. The reason is the US, as much as it's our reference rate, there is AA rated. So you find that since it's dominant in that index, the total index rating is sort of gravitates towards the rating of the US, which is AA. Single A, that's about 12%. AA, that's about 13%. So you find that the universe global aggregate bond index is predominantly the US, which is about just over 70%, like you'd see in the MSCI, all country weighted index, which is also predominantly the US. And so the view that we have about the US influences the weighting or the allocation that you want to give to global bonds as well. If we go on to the next slide, we just want to touch on, next slide, please. We want to just touch on how yields have changed over the past few years. I know there's a colleague who also presented in January. We had this chart, but I just thought we'd just refresh our minds on that. So beginning of the 1980s, bond yields, the nominal ones were at 14% when we started, and then they troughed in 2020, 2021 during COVID. You will find that they rallied from 14%, the nominal yields that are in red, and troughed just above zero in 2020, 2021, and 2022 with the inflation scare, they then went up to between 5 and 4%, like where they are now. So just to put things into perspective, you also see that the real yields, which is the nominal bond subtracted inflation, you see that real yields there were at 8 beginning of 1982. They were negative for some periods, especially in the 2020 year, and those have ticked up to around 2% now. So depending on where inflation falls, I think at 5%, they are higher than where we were when we started the decade. So, the reason why we also look at yields is that the starting point of yields is quite important for the return. And the second thing that we also looked at this chart is that you'll find that many people say bond yields are quite low. That was the narrative, from 2010 to 2020. But you see that those have since corrected to higher levels at around 5%, which almost feels normal in the 2000s. Then in our next chart, we just look at we just want to look at the returns of bonds. If we go on to the next slide, the returns of bonds, again, from 1976. The reason why we talk of bonds is that if you look at the returns in 2022, bonds had a big drawdown of about 13%, according to Bloomberg, on an annual basis. So I think the fear that bonds are not as safe as they were is one aspect that I thought we can touch before we just move on. So from 1976, of those 49 years, bond returns were positive for 43 of those. In fact, if you look at 2022, that big drawdown was sort of a multi-decade drawdown. If I'll say gray swan, not black swan, in terms of bond returns. So in a portfolio, you'd expect your average returns to be about 5 or 6% in US dollars. Obviously, with the starting point in 2022 being almost near zero returns. So that aspect, I think you'd find that many portfolios since then, that are reactive, were underweight this market. But we think it's got its place. It gives you 5 to 6% in dollars average over time, and what we see there is 2022, because of the starting points, there was a big drawdown. But going forward, you'd see that in the other years, bonds had just given you minus 2 in terms of their returns. So they give you stability, and they also provide the yield or the income that you need in terms of diversification. I think you've seen with the presentation that we've had before, how when other markets, in this case, the property, a bit shaky, I think bonds provide that income and diversification that you need in the portfolio. Then if we go on to the next slide, just to touch on the point on the starting point, how the starting point influences the returns in bonds. On our left, we've got a chart that shows the starting yield, and in terms of the starting yields of bonds, then the returns that follow would be on the vertical axis. So again, if we do this from the 1970s up to the 2020s, obviously, this year is more of a forecast more than anything. But if we just look at the correlation there, the starting point has got about 88% influence on the returns, 5-year annualized returns or subsequent 5-year annualized returns. So what we see there is currently yields just under 5, and the subsequent returns there are also at around 5%. So that's with a 88% kind of correlation, R squared in terms of explanation. Then if we also look at S&P 500 total return, there's a bit of clustering there that we also need to take care of. The relationship is not as strong in the S&P 500, but it's showing that with the way PEs are elevated, equity returns 5 years annualized sort of will be depressed and won't be as high as we expected between 2010 and 2020. So again, in terms of looking for something that fits in a portfolio that provides diversification and stable returns, plus or minus between 5 and 6%, I think that's where global bonds sort of fit. Obviously, last year equities did well. Bonds also gave something, but not as much. But you see that at the beginning of the year with the volatility, bonds did provide. We'll just move to the next slide just to also look at one aspect that's really that influences the inflation, that influences the bond returns, which is the inflation outlook. Again, focusing on 2022, when there was the inflation scare driven by commodities, you'll find that the inflation bit that we saw in 2022, the inflation spike that we saw in 2022, was mainly driven by energy, the green part of the chart that we have, and disinflation that we saw in 2020 was driven by energy. But one thing that has been constant across is the dark blue base, which is the rent or housing inflation, owner's equivalent rent. We see that when it's going up, when it's stable, inflation is stable. When it's going up, inflation also goes up. And what we are seeing in owner's equivalent rent in the US now is moderating. The dark blue base there is falling, and we think that provides downward pressure to that shelter inflation, provides downward inflation, pressure to inflation, and downward pressure to yields. Then, if we just look at owner's equivalent rent on the chart on our right, you see that the red line is falling. So we think inflation over the near term, coming year, to be more specific, is the pressure is for it to go down. There might be some base effects this quarter and the next quarter, and if inflation is contained, we still think that will provide a base for the yields to also be contained. Then there's the next slide where we also talk about the current theme, given the change in the administration in the US. You see that tariffs, I'll start with the chart in the right. The tariffs in the US, we all have different economies have got tariffs, but what we have on our right there is just to look at how the tariff rates has been in the US. So it's not something new. You see that the lines show the tariffs, the average tariff rates in the US since the 1820s up to now. The blue lines, that's what's not tariffed, and then the orange line also show the, durable, dutiable goods, or the goods that tariffs are applied on. So you find that, in the 1920s, there were quite a bit of tariffs there in the US. But one thing that I wanted to show is that then after, with the Bretton Woods, after the Second World War, you will find that tariffs were falling globally, which led to global trade. But with the new administration coming in, we see that tariffs will start rising. But one point I wanted to mention is that 1920s, the tariffs were quite high, up to 60% on some goods. You know that at the end of the 1920s, 1929, the Great Depression. So it doesn't necessarily mean that when tariffs come, inflation goes up. In fact, end of that decade, there was deflation. And then if we go to the chart on our left, we also show a chart where we look at the US dollar, how it reacted, second again, Trump's first term from 2017 up to 2020 or 2021, if you're using inauguration dates. The first tariffs were in March 2018, 1st of March, tariffs on steel and aluminium, 2nd of March, the tweet, and then 8th of March, that's when an executive order was signed. So there, negotiating technique for the US government then. And then we see that the US dollar, that dark blue line, the US dollar index strengthened then from March 2018 up to January 2020. So the impact of tariffs that we saw then was the strengthening US dollar. So in terms of yields, if we look in the first week of February, when tariffs were announced, we don't have the chart here as well, but we see that the dollar strengthened. For us, SA, obviously, with issues on the sanctioning, we can't really strip out the US dollar and the rand because of other issues other than tariffs. But with other economies, we saw that the dollar also strengthened with tariffs coming. So over and above the uncertainty, I think the strengthening dollar is also something that we expect with the tariffs that are coming through. Then I'll just look at one other slide just to broaden again our perspective in terms of the issues that have been talked about regarding the US debt, case bonds and investment. The first bit.
Fanny, sorry to interrupt you. The clock is catching us. So if I can maybe ask you just to conclude.
Okay, all right, that's fine. So if we go on to the next chart, we just want to then mention about our fund, which obviously fund objective is outperform the Bloomberg Aggregate Bond Index by 1% over a rolling 12-month basis. And the way we do it is we just want to combine the strength of passive investing, that's low fees, and active strategies by porting alpha. Rather than using alpha, taking alpha from bonds, we want to take alpha from cash. So we use a portable alpha strategy, and the anatomy is what we break down in the coming slide. If we go to the next slide, so what we want to do there is we not necessarily active, but we want to occupy the core, different solutions. We have a core part and a satellite part. And what we want to replace in our case is to replace the core, where instead of having a passive ETF, we have an enhanced core, lower risk profile, but providing an alpha. And how do we do that? We go on to the next slide where we, from combining cash and the future, we have a total index return. But what we then do in our portable alpha strategy is we then use our enhanced cash as a house. And in that enhanced cash, that's where we get the alpha. We still use the future, which provides the beta to the portfolio. And what we have combined is the index return, the Bloomberg Ag, together with the alpha. So it's a stable alpha, and it's consistent given that our source of alpha there is cash. Then one slide that we want to touch on is in terms of the portfolio makeup. Again, the duration of the fund similar to that of the benchmark, the Ag 5.81 compared to 5.89. You see that that's similar duration to what we've got in the OLB. In terms of the treasury, it's full replication. 44% is treasury. Remember, 25% is mortgage-based securities and industrials. Then the yield of the fund, you'll see that the yield of the fund hedged back to dollars is a percent above that of the benchmark. So it's a 5.81, in fact, versus the 4.81 yield of the fund. So I think in a nutshell, global bonds provide 5 to 6% in terms of yield, and they provide diversification. And through using a portable alpha strategy in our fund, you will find that we want to replace the core of the fund and provide return. I think I'll end here, Eugene. The other slides, I think it's up to the... Yeah.
Faniel, thank you very much for that insightful lead. I've got a whole bunch of questions in terms of your overall portfolio construction methodology, but we're going to park it there in the sense of time. There's an open question from Sean as well, which we will circulate through to you. It's got to do with mortgage-backed securities that you also hold in the portfolio, and just testing your views on tips. But like I said, we'll circulate that question through to you if you can maybe comment on that, and we'll get it back to the audience. Thank you so much for your time this morning. Insightful as always, and hope to see you again in the near future. Thank you so much.
Thank you, Eugene. Thank you.
Right, we're stepping on to global emerging markets. Lots of talk in emerging markets as the tide could be turning. EM's obviously offering attractive valuations relative to developed markets. We've heard some of the portfolio managers commenting on gaining access to emerging market earnings through DM stocks. But should we look at actually allocating to emerging markets? And who better to cover that than Lars Hachenbach from Riskero, based in London. Lars, good morning. Thank you so much for joining us.
Eugene, yes, thank you for having us on the webinar. I apologize slightly for the orange color of my skin. There's nothing actually wrong with me. Our camera seems to be doing a bit of a funny thing here. But yeah, so let's...
That's right into the Apex colors, so that's fine.
Well, there we go. It must have known. So thanks again for having us on. Obviously appreciate the time and the support. So what I was going to do is really just spend the next 15-20 minutes looking through trends and some insights in emerging markets in general. Looking back at 2024, the global economy was driven primarily by a pretty robust US economy. I mean, not sort of shooting the lights out, but very solid growth out of the US. And equity markets there, particularly the Magnificent Seven tech behemoths, as they're known, demonstrating very strong performance and giving rise to some very elevated valuations towards the end of the year. We did hear briefly in the previous presentation about the path of interest rates. So the Fed did actually not cut rates as often as had been anticipated. So there were some rate cuts, but not as many as before. Inflation did prove to be a little bit more sticky than they had anticipated. Going forward, a little bit of a case of let's wait and see what happens with the incoming President Trump. For sure, there are going to be policy shifts, and those will have implications for global markets. Again, the previous speaker talked us through some of the tariff thinking, but also domestically in the US, many of the policies that President Trump and his administration are advocating are not necessarily inflation friendly. In other words, they are likely to be inflationary. and that may indeed have implications for the path of interest rates, which, if you remember from a previous webinar that we've done with you guys, recall that high interest rates in the US tend to be adverse for emerging markets, because it means that developed market asset owners and capital providers tend to keep their money at home and don't end up sending it to investment opportunities or in emerging markets. Dollar and gold maintained their strength. In fact, the gold price actually hit a record high just a few days ago on the back of further uncertainty in geopolitics. And for once, the Chinese markets, which are still the biggest component of the emerging markets index, they received a boost in September, a very, very significant boost. In fact, in the month of September, the Chinese equity markets were up by about 25% within the space of about a week or week and a half, as the Chinese authorities sort of finally got round to some quite significant stimulus measures there. And they do still have dry powder on that front. But I think everyone right now is in a little bit of a wait and see mode, again, to observe the actions of the US administration. So over the year, the developed markets did outperform emerging market equities, about 19% for DMs, just under 8% for emerging markets. So emerging market equities lagged, but still reasonable performance. You still got about 8%. These are all numbers in US dollars. So despite the dollar itself being relatively strong, despite the market volatility, there was a reasonable return. And South Africa, as one of the components of the EM index, actually had a pretty decent year as well, on the back of investors typically looking at the National Unity Government with its reasonably pro-business stance. Load shedding is kind of a thing of the past. I know there's been a little bit of load shedding again in the last 2 weeks or so, but generally speaking, that looks like it's a thing of the past. So just on the next page, looking at that same information in a chart. So the MSCI World, the orange line in the middle, is really being driven by the performance of the S&P. US equities make up the majority of the MSCI World. Emerging markets, the light blue line, lagging. And as I said, so I've added China and South Africa as the two, China again being the most highest weighting in the EM index, had a very strong Q3, and then South Africa I've just spoken to as well. On the next page, just looking at the same information in the fixed income markets. Here too, the South African market actually is one of the standout performers for the year across emerging markets. But otherwise, actually, emerging market bonds did reasonably well over the year, in fact, outperforming the developed market bond index. On the next page, I've just indicated some GDP realized as well as forward-looking assumptions. And sort of working from left to right, you'll see that all the countries which have relatively high expected GDP growth for 2025 are emerging markets, led by India. We'll say a few words about India in a few minutes' time, but India looking at an expected GDP growth for the year of in excess of 7%. The Modi government, which was re-elected last year, is relatively pro-business, but they're also doing good work in terms of sorting out some of the infrastructure issues across India, and also population-wise. So India is now the country with the world's largest population of about 1.4 billion people, and it's quite an industrious sort of population. So people tend to be quite to busy themselves with sort of small entrepreneurial activities whenever they can. But if you add that into a better framework for capital formation, a better financial system, a better infrastructure system, that really unleashes GDP growth. So India is very much a bright spark. Neighboring countries, Indonesia, Malaysia, all in excess of 5% or just under. China also, again, still the heavyweight in this index. Their expected growth to slow slightly, but at 4.5% is still an enviable number, and in fact is expected to be almost twice the growth rate that we would like to get out of the US. On the next page, again, we spoke about inflation in the previous speaker had a few words there. There was a big spike clearly in and around 2022, and that really gave rise to the interest rates being raised so significantly. And that's also why you remember the previous speaker, he mentioned that the global bonds had a very poor year in 2022. Well, the background to that was the spike in inflation and central banks reacting to that. But the inflation is now largely under control. It is a little bit sticky still. I mentioned that in my opening remarks. The Fed has not reduced its interest rates at quite the speed that market was expecting. Inflation is a bit sticky, particularly in the US. Sort of wage inflation has been difficult to get to come down, and now with the prospect going forward of tariffs, those, depending on sort of how they're passed through, whether it's the end consumer who bears the burden of those tariffs, or whether it's the supplier who bears the burden, they are likely to be inflationary, because it stands to reason that at least some of the burden will be borne by the consumer. So we are likely to see higher prices for some of the metals. In fact, there was a 25% tariff on aluminium and steel that's about to be introduced in the US, and of course those are quite key industrial metals. So yeah, we are likely to see inflation remaining relatively high, and that will mean that interest rates are going to remain relatively high. In fact, on the next page, we do have a look at the path of interest rates. As I said, the reduction cycle is underway. The Chinese have been reducing interest rates for some time already. That's the dark blue line. They've had some quite unique issues connected to their property sector. And they've been trying to solve that a little bit by keeping interest rates and hence mortgage rates as low as possible. But elsewhere, the Fed has had several reductions already, at least 2, I think, here. And the European Central Bank also has been on a reduction. On the next page, we spoke about the relative performance of the S&P versus other global markets. Here I'm just plotting one of the valuation measures, which is the price to book ratio for the S&P 500, and comparing that to the emerging markets index. The S&P's price to book ratio is now at levels that we haven't seen since the tech bubble in the late 90s, early 2000s. So very, very aggressive valuations on a price to book basis. On the next page, we look at it on a forward-looking price to earnings basis. And here also we are very much in overvalued, expensive territory. So you can kind of ignore the little blip in there's the orange line I'm talking to now, which is the MSCI World Index's forward-looking PE ratio. Again, remember that is dominated by the US. The very high numbers we saw in 2021, that was during the COVID period, when interest rates were aggressively reduced. Companies were not making a great deal of money, but equity prices actually stayed kind of where they were. After having initially had a bit of a crash, they recovered quickly, and then it was sort of slightly positive throughout that COVID window. So if we ignore that 2021 period, you can see that we haven't seen forward price earnings multiples for the world, i.e. the US, as high as we have for the last 20 years. So that's really quite aggressive. Emerging markets, on the other hand, are very much in line with their historical long-term averages, somewhere between 13-ish times forward-looking basis. China is arguably on the cheap end of that, at around about 11 forward-looking. South Africa, so the African indices, even cheaper still. A little bit harder to get access to those, but yeah, I mean, for sure, emerging markets, looking at it on this basis, are offering much more attractive forward-looking valuations than the developed markets. In fact, if we look at it on the next page, you look at the two relative to each other. So the ratio of forward PEs developed versus emerging markets. If the line is above the sort of the top dotted line, then it suggests that developed market equities are trading at a discount. And whereas if they're below the bottom gray line, then it's emerging markets who are trading at a discount. And so right now we actually are seeing levels of cheapness, relative cheapness for global emerging markets at levels we haven't seen in the last 15 years, give or take. So that current valuation gap, looking at this on a relative basis, plus also the price to book chart we saw earlier, does suggest that emerging market equities could offer quite reasonable upside potential through a re-rating and earnings growth. So the earnings growth will come through from the GDP growth we spoke to. The re-rating would come through, here as PEs normalize. You kind of get relative PEs back to the sort of mid-range here. So yeah, there's an access point for investors into cheaper markets compared to the relatively expensive US, and then depending on the path of interest rates in the US, then that would also be a catalyst for global investors to start looking for higher yield and more attractive opportunities in emerging markets in a more risk-on environment, which could lead to a rally in emerging markets prices. I think finally, just to look at the next page, which is the relative earnings growth expectations. The US for 2025 is still quite robust, looking at about 15% expected growth there. The Eurozone is really struggling. Germany is really in trouble at the minute. The car industry, which used to power Germany's growth, is having a really tough time. So the Eurozone is not doing particularly well. Expected growth in earnings for this year, a little bit better for next year. But emerging markets on the far right-hand side actually are very much keeping up. So for this year, expected to in fact be better earnings growth than we're seeing in the United States. But then a lot of this stuff, as we'll talk about a little bit in a minute, is down to policy moves that happen out of the Trump administration. And the final one, just before we do a deep dive into one or two countries on the next page, is just a reminder that emerging markets continue to offer diversification from developed markets. So not only are there current valuation attractiveness points, but in general, as a longer term holder, emerging market equities are diversifying from developed market equities, so they don't necessarily all behave and generate movements that are synchronized. So for a portfolio investor, having an exposure to emerging markets is quite attractive. And even though it's not shown here, I can remember I showed it to you guys on a previous webinar. The question often is asked whether emerging markets equities offer diversification from a South African investor point of view, because of course South Africa is itself also an emerging market. And the answer there too is actually it is quite diversifying, because the emerging markets index is more heavily dominated by the likes of China, India, Taiwan, whose economic makeup is really very different to that of South Africa. They have a much higher industrial base. They have different labor market dynamics, very much higher technology sector, which isn't as represented in SA. So there are very clear diversification benefits even from an SA perspective. Anyway, moving on swiftly. I thought I'd just say a few words about India and a few words about China, and then sort of wrap it up. So India really is the bright spark from a expected GDP growth perspective. So this chart is plotting the forward-looking expected GDP growth for India for the next sort of 30 years out. I mean, obviously you take the far right-hand side numbers with a bit of pinch of salt, but certainly for the next 10 years, India is projected to be really quite decent GDP growth, numbers between 7% and 9%. I mean, that's the sort of performance that we had out of the Chinese economy a decade ago or so. India is really poised to take over that role as being the key driver of growth in emerging markets. Off a slightly lower base, so let's bear that in mind. But certainly from a growth perspective, that's quite attractive. But it does remain expensive. So on the next page, we have a look at the forward PE ratio of India, and comparing it in this case to China, which is the dark blue line, and the EM index itself, which is the gray line. So India has traded at relatively expensive valuations for some time. That continues to be the case. So forward PE there of around 25, which compares to less than 15 for the Chinese market or for the index overall. So certainly, the Indian equities are trading a little bit at relatively aggressive valuations, much more like the US market. But yeah, there is the much higher economic growth that underpins that. But one of the things about the Indian market overall is that it's not necessarily just in equities where there are opportunities. The Indian private equity market is also quite interesting. The private debt market is quite interesting. So there are opportunities to access the Indian market beyond just looking at the listed equity market. On the next page, I've just indicated some of the headwinds and tailwinds in the Indian market. So on a valuation basis, as I've just said, it is still expensive. PEs of about 25 is aggressive. But some market segments, like I think large caps, are a little bit more attractive. The PE levels are a little bit lower there. But that just suggests that investing in India is an active management activity. Like, you need to be with active managers who are selecting the correct stocks across India, as opposed to just buying the index. And who will be able to unlock better value there. The real estate sector in India is also a little bit sticky. There are still some issues there that need to be addressed. But even so, the sector is currently yielding about 10% return, which is actually still quite attractive. In terms of tailwinds, there are quite a few there. So India is around 20% of the emerging markets index right now. But as I said, just buying the benchmark might not be the best way to get access there. True alpha is really unlocked in India through active management of by Indian equity managers, local managers, selecting stocks, blending styles. Infrastructure has been a big focus. The Modi administration, as I said earlier, has focused on improving infrastructure, and that includes not just roads and sort of dams and physical infrastructure, but also financial infrastructure. So the banking system, looking at broadband internet access for the population. So all of these things make a big difference to the sustainability of growth going forward once you have it in place. Economic growth expected to be quite strong. Corruption has historically been a bit of an issue in India. So Indian companies have historically been known for relatively poor governance. They often are run by founders who really are, they call them promoters in India, it's the term they use, but basically the people or families who found the companies often find it difficult to let go of that control. They don't necessarily always run the company in the best interest of minority shareholders. And that has had some issues for those minorities. It has had an impact on the efficiency of capital allocation. But we've seen a very, very significant decline in these sort of governance issues. I think even the quite tightly held companies have realized that good governance, that decent capital allocation does improve returns, not just for themselves, but for everybody. So that's definitely a factor. Population dynamics. India is now the largest country in the world by population, just over 1.4 billion people. And that demographic trend just drives productivity. It fuels growth, spurs innovation. India particularly is known for its technology sector, software in particular across India. In fact, a lot of developed market companies at least, make quite significant use of Indian software engineers when it comes to developing programs and applications. Just looking at the next page, a couple of words on China. Those of you who watch China actively will be aware that China had what I'm calling the DeepSeek moment a little while ago. DeepSeek is an artificial intelligence company. It was founded about 2 or 3 years ago by a private investor, basically a guy who runs one of China's very successful hedge funds. He bankrolled this artificial intelligence startup called DeepSeek, and it was really a game changer when they came out last month with the results of their models and their large language learning model, which was able to match some of the achievements from OpenAI, which is really the poster child in artificial intelligence, but doing so at a fraction of the cost. And some of that really is down to again, those of you who are regular China watchers will recall that China has been under an export ban for high technology equipment and chips. particularly chips that are used in artificial intelligence machines and learning. And so the Chinese engineers have had to really squeeze a lot more juice out of some of the older, less powerful chips. And that has basically just meant that they've come up with more efficient code as a result, in order to try and deliver similar results using older chips, using less expensive chips, less energy and power is required to get to the same result. And so DeepSeek was very much an earthquake moment for the artificial intelligence sector overall. NVIDIA, which is one of the other big players in the sector from a chips manufacturing point of view, I recall, I think their share price collapsed by about 20% on the day that DeepSeek came out, because it just indicated that the US's approach of throwing large amounts of money at the artificial intelligence problem might not be the best way to go. I mean, it's kind of, I suppose, it's intuitive, but there was an eye opener for a lot of the players in that sector. So yeah, watch this space. For sure, economic isolation, while not necessarily great for an economy overall, does have its benefits in that it forces you to come up with technology internally to compete with what you no longer have access to. And then my closing slide is just a few words about geopolitics. There's a picture of a scowling man in the middle that is actually the official portrait of President Trump, due to be seen in airports and federal buildings across the US very soon. And he's only been in power for well, it's not even a month yet, but it's been hectic. I think it's the only way to really describe it. Some of which has actually impacted South Africa very clearly. US aid being one of those, both the agency, so the US aid federal agency that is supposed to be responsible for distributing humanitarian aid across the globe. There's the attempts are being made to shutter that completely, with sort of very severe consequences for downstream contractors, as well as, of course, the people who are due to receive that aid. But also, using aid as a way to try and encourage countries to behave in a particular way. South Africa was singled out very recently there for some of its policies, saying, well, you're not going to get any more aid because I'm not happy with your policies. And that same tool looks like it's now being applied in the Middle East. The King of Jordan is just meeting with President Trump right now. And there's talk there of trying to stop aid to Jordan unless they're taking Palestinian refugees. So a lot of very direct intervention by using economic power. Tariffs we've spoken about, trade wars. What does it mean for supply chains? Climate change is likely to take a back seat, or the emphasis, at least, on preventing climate change is likely to take a significant back seat, and be replaced by the drill baby drill mantra that President Trump has been quick to espouse. So overall, there's a lot of uncertainty coming here. Some of these are going to be easier to work around than others, for sure. What it is likely to mean, though, and now wearing my emerging markets hat again, is yes, there will be some initial issues, particularly if tariffs are imposed, that could give rise to reduced demand for certain products or raw materials from US consumers. But a lot of this stuff that the emerging markets produce, the US doesn't have in plentiful quantity itself. So it's still going to be expected to buy some of those products, and it may end up being nothing more than inflationary for the US consumer. So that is one possible outcome. But what is also likely to happen is that emerging market countries will just start trading a lot more amongst themselves. Again, this is a point I remember making in a previous webinar with you guys. But China trading with India, China trading with Indonesia, Indonesia trading with the Philippines, a lot of kind of cross-border transactions happening across Southeast Asia, in Latin America. Mexico might now end up trading much more actively with Colombia, with Chile, with Brazil. Huge market in Brazil. It's got its own issues, Brazil, but there are a lot of people there still need to buy things. So as the US becomes more and more insulated and isolationist, one of the consequences is quite possibly that emerging markets do trade a lot more amongst themselves. And markets are actually quite resilient. There have been we've seen this sort of behavior before during the first Trump presidency. Many of the same themes came out then. China has substantial cash reserves. It has recently issued a wide range of stimulus measures. We haven't seen a lot of activity or commentary from the Chinese authorities in the last month or so. They're pretty much playing a waiting game to see, like, where does this US policy direction settle? How much of the stuff that President Trump is trying to do is actually enforceable? How much can he do? How much of it is going to be challenged in the courts? So there's quite a lot of question marks there, and I think the Chinese are really just waiting, biding their time. But may well use a vacuum left by the US to influence and to economically support some of the countries, perhaps particularly across Africa. The Chinese have a very strong footprint across Africa already, and can use the departing US influence there to improve their own economic relationships and trade with those African countries. Anyway, that was me. Eugene, thanks. I see you've just come back on again. That probably suggests that we're out of time. So yeah, thanks very much for your attention. Just a quick reminder, on the BCI platform, we have both an emerging markets fund, so it's a wide emerging markets equity fund, as well as a China dedicated product. Depending on how you want to play the emerging market story, there are opportunities to access that.
And the China fund, obviously a multi-managed fund as well. So
indeed, both of those multi-managed funds. Yeah.
Indeed. Last couple of questions from the audience, but I'll try to combine everything into one question for the interest of time. And I mean, I tend to agree with you. We don't yet know where all these trade wars are going, but you can argue that Trump might be driving the rest of the world into the arms of China and to some extent India. But that speaks to part of some of the questions coming in. And we've seen how emerging market allocations comes with higher levels of volatility. And I think the nuts and bolts of it is why EM, if you think that not only the US or parts of the US market and other developed markets are also trading at reasonable valuations, if you exclude the Max 7. Why not then go for those markets where there might be a little bit more or less volatility, as what was the case in the past? Why allocate more to EM now, and what would you allocate to EM?
Sure. So I think a couple of ways to answer the question. Your observation is correct that the US market, if you strip out the very highly rated technology companies, it is trading at a slightly more attractive valuation. So that's fine. Will there be volatility going forward in the US market, given the Trump administration's policies? I think that we should expect. So it's been a kind of a comfortable ride for a while, but I think forward looking, we should expect more volatility out of the US, and that is then going to drive developed markets volatility. So I think that really the best answer to the question is it's a diversification argument, right? So we don't necessarily know how this is going to play out, how the policies and tariffs and everything else is going to play out. We do know that emerging markets, particularly India and some of the neighboring countries there, offer, on a forward-looking growth basis, very attractive numbers. So if you don't know where the hotspot is going to be going forward, your best strategy is to put a little bit of money across the board and not to concentrate it only in one or two countries or one or two sectors, because then there may be an adverse policy, like this, the OpenAI, the artificial intelligence one. Sure, it's a volatile thing, but all it needed was one company to come along with a better technology, a cheaper technology, and suddenly you lose 20%. In what up to that point had been a complete no-brainer. Yeah, you've got to be in artificial intelligence. Everyone is doing it. It's the way of the future. And suddenly 20% later, you don't look so clever anymore. So diversification really is the key thing here. And emerging markets, they're cheap entry points. It's tough to argue against that.
We've seen a couple of comments from Macron as well in Paris on AI and mocking some of these companies. That was very interesting indeed. I tend to agree with you on emerging markets. It is a good diversification, and you might see a lot more volatility from the US as what you've experienced over the past 13 years. Lars, thank you very much for your time. Great to have you on as always and sharing insights on emerging markets. And we'll chat soon again. If for the audience, if you want more information on China or you want to chat about China, get hold of us and we'll get you in touch with Lars. Lars, thank you so much.
Yeah, thanks, Eugene, and have a good morning, everybody.
Fantastic. We continue with global equity through the eyes of one of the most established asset management companies in London, Lindsell Train, all the way from London. It's my absolute pleasure to welcome James Bullock, Director and Portfolio Manager. James, good morning. Thank you for joining us this morning. Sorry to keep you waiting a bit. Always great to have you on our sessions, and thank you for your time.
Thank you, Eugene. It is lovely to be here. Very good morning to everybody. No, we really appreciate you all taking the time to join us for the segment. And yeah, thanks, Eugene. Thanks, Tanya. Thanks, BCI, for facilitating the whole thing. I'm going to address equities and market performance in a little minute. But I thought I might first start, if Eugene will permit me, to just give you a quick refresher on the Lindsell Train investment philosophy. The reason being that this is, if you like, our methodology for navigating the volatility that we see around us. We just heard an awful lot about the uncertainty that the world faces. And as equity investors, we deliberately try to address this via a focus on high quality companies, right? So we're looking at investing in businesses that are better than average, those that are compounding their cash flows at higher than average rates, backed by long, rich heritage, giving them stability even in uncertain times, giving them durability to continue that compounding at a sustainably high clip over long periods of time. And that's really the foundation to what we're trying to do. And think about compounding. Compounding plus the time that you allow it. Those are the two, in our view, key ingredients to really building long-term value creation. And so what we're trying to do is find deeply moated businesses and then resist the temptation to disturb them along the way. So we've got a portfolio with returns to equity, returns to capital that are unusually high. We've got holding periods that are unusually long. The average per annum turnover for our strategy is less than 5%. And if you look up on screen, we've got a couple of quotes. We've got one from Warren Buffett. He's a massive influence. We've got one from Charlie Munger. And the second one there is just wanting to emphasize the fact that actually it really is the companies that we hold, that you, if you're equity investors, hold, that are generating wealth, that are creating value. At least in our view, it's not the clever trading in and out of them. It's holding on to these businesses and allowing them to create the value for you. So if we just jump on to the next slide, which shows you our portfolio. These are the companies that we own. This is a list of 25 exceptional businesses in our view. It's pretty narrowly spread across leading heritage-rich consumer franchises with strong brands, differentiated media and software companies. These are the owners of monopolistic, unique IP, and then strongly networked payments or marketplace companies. And here I'm going to, well, firstly have that up on screen for a second, but maybe in the interest of time, if we jump to the next slide, I'm going to make a little comment on our strategy's recent performance. Certainly, I think for any investors with us on the call today, that's going to be highly topical. But for everyone else, in a more general sense, I think kind of decomposing the mechanics of the performance will I hope be of interest. And that's not least as well, sadly, 2024 marks a further year of relative underperformance for us, and that follows on the heels of 3 relatively disappointing years as well, and that in all cases falls below our expectations. But I think there are some quite important positives to pick out of, particularly last year, and I hope that will give us some encouragement as we look a little ahead. The first point to make is that despite the relative disappointment, our calendar year returns, and these are all in GBP and sterling. So the calendar year returns of 13.5%, they actually sit in line with, if not slightly ahead of our long-term performance, and that's a track record that we are proud of. But from a relative perspective, and here I'm going to kind of diverge into some more general comments on the world markets, really. The performance of the index itself remains both unusually elevated compared to its history and highly concentrated. Now, much of that performance is owed to a small number of stocks. You've heard previous speakers talking about the Magnificent Seven. They are incredibly topical for anyone looking at equities. But I think it's important to re-underline the idea that that they have driven a lot of recent returns. Now, that may be no surprise to you. Portfolio returns are very often driven by a small number of star names. That's perhaps to be expected, but I think it does mean that we need to think about the world index as a portfolio, and quite a concentrated one at that. So, you heard from Lars in the last session about valuations and looking relatively expensive versus history. That's been driven by that very strong performance ahead of earnings growth for the markets. That's led to these high multiples. And it means that the performance in 2024, for example, of the MSCI World does not reflect that of the average company. To get that, I think we have instead to look at an equally weighted version of the MSCI World. And that, in fact, returned a far more historically consistent 9% in sterling terms. So that's roughly in line with the index's history. It's obviously behind our global equity strategy's performance. So I think we can say that for what it's worth, our companies, which we deem to be better than average, have at least fulfilled their brief of performing better than average as well. Now, obviously, if a company like Nvidia goes on another tear in 2025, then the MSCI World portfolio may well again outperform the average business. And I think we are continuing to bear that risk by not owning these kinds of stocks, and specifically the AI thematic stocks. But I don't think that means we or you have to be pessimistic. And even if we leave DeepSeek to one side, and if we continue to believe that one continues to believe that the AI gold rush has further to run, bear in mind that the world index contains 1,400 stocks. In addition to that, there's probably another 10,000 globally listed businesses outside of the index. And so whilst you have a big company like Nvidia, if you told somebody 10 years ago that a chip maker would be worth $3 trillion, they'd consider you mad. But that makes it more than 5% of the world index. It doesn't mean there are no winners left elsewhere. And so I think I'm saying that there are two approaches investors can take. You can either scurry around and try to own every single great stock, obsess over those you miss, the fear of missing out, which is a pretty important psychological driver for a lot of people, or you can concentrate down within your circle of competence to a well-curated portfolio and really just work towards doing your homework to make sure every stock that you do own is a great one. And obviously, I have some sympathy with the former approach, but it's pretty exhausting. It forces you to try to do everything, to understand everything, to know everything, to be searching at all times, to be running on that treadmill. And I think it's pretty hard to work from that into thoughtful concentration, long-termism, or ultimately sustainable performance. And so here I thought it would be interesting if we could jump on one more slide to look at some of the companies we own. Again, take it back to the businesses themselves, the ones creating value. Talk to you for a minute or two about how they've done that over the last 12 months. And again, I think if we look at this list, this is our top and bottom performers. Despite the relative underperformance, I don't think we can be too unhappy with a list of stocks out of which, you know, a good chunk, 7 out of our 25 names, have made our investors 40% more on their money. Now, if you look at the left-hand list, TKO sits right at the top with a very welcome 77% return over the year. And just to remind you, and we've got another slide on this that we can look at. TKO is the combination of 2 entertainment franchises, so it's WWE and UFC. And the former, WWE, we have owned going back all the way to 2011. Now, this next slide coming up shows you the performance of the company since that 2011 inception for us. So that's the return versus the MSCI World. And I think the pretty dramatic point here is that the stock has been a volatile one. You know, don't necessarily fear volatility on a share price, on an individual share price perspective. You know, without exaggerating, this has really tested patience. You know, more than a few times. You can see I've marked on 3 separate multi-year periods of very poor relative and absolute performance. However, throughout, we have held on to it. We've believed in the value of its unique intellectual property, you know, the shows that it puts out, the characters that it creates, the passion of the fan base surrounding that, and frankly, the company's vision to monetize that passion around the world. We have never sold a share unless we could have avoided it. And to date, as you can see on the screen, we've realized a 21-fold total return. So it's really us emphasizing this message of patience and the fact that you may have to wait through difficult periods, but if you've done the underlying work and the business is of genuinely high quality, if it has moats that are very hard to disrupt, then it is worth holding on for those with a long-term perspective. Specifically this year, the drivers of the business have been the synergies, so merging these 2 entities. That's from the revenue and the cost side. They also have a major new contract with Netflix recently started, which brings their content even more to a global audience. It also locks in for a decade plus their TV rights, resolving any uncertainty. So imagine a business that's got 10 years worth of visibility to a large chunk of its earnings. If we go back on one more slide, sorry, go forwards one more slide, it will take us actually back to that list of the top and bottom performers. And I just sort of give a 10-second comment on FICO, because it's, you know, it to us is that proof that the Magnificent Seven is far from the only source of strong returns. I mean, we've owned FICO actually since 2022, so much more recently. But from 22 to the end of last year, the stock has roughly quadrupled. It has incredible pricing power. Again, it's thanks to intellectual property. It's thanks to heritage that no other business can match, that no other business can replicate. You know, its margin has expanded, and on already wide margins, and expanded to nearly 50%. Regulatory concerns have eased. It's been a great story for us. But I think it is important to talk about the other side, the bottom performers. There are less of them, which is great. But Shiseido sits up there, you know, really a major disappointment for us. Down 39% over the year. Actually, since 2019, it's been a disappointment. If we move on to the next slide, there's a chart to illustrate that. You know, this we actually put together when kind of reflecting on the pandemic, and that's the grey bars on the chart, and how big an impact that had on some of our previously high achievers, Shiseido included. And the charts are from a total return perspective, again in GBP. The table on the bottom right, though, you may have to zoom in to read it, but the table on the bottom right is showing you the operating margins for Shiseido as well. So it's, you know, I kind of, you know, accepting it's not just earnings multiples that have changed for these businesses. They've actually had a pretty hard time through the pandemic as well. And if you think about Shiseido's case specifically, that is the complete collapse of the tourist market. Tourist trade was a really booming area for them. Travel, retail, duty free, the market in China as well, which has been going through its own issues. You know, all of these things, throw a bit of politics in on top, have had a major impact. Shiseido's revenues have not fallen that much, but the margin really has, and the share price along with it. You know, I think our comment here is that evidently the company can generate strong returns. I mean, it had worked its way up to a pretty decent margin and was heading in absolutely the right direction. The share price pre-2020 was pretty spectacular, frankly. And yeah, when you look at global peers like L'Oreal, there's also a fairly clear target for them in terms of profitability if it can sort out some of the nearer term issues. You know, we engage with management. I think that's important to assess their strategic priorities for capital allocation, balance sheet, but underlying that, a little bit like with TKO, you know, we believe in the strength of the brand, the uniqueness of the franchise. And again, looking back to that TKO chart, you know, a pause in compounding doesn't necessarily mean that it's stopped. So for now, we are patient with Shiseido. I thought here I'll talk a little bit about, again, some of the mechanics of performance, which may, I hope, be of interest. So if we go on one more slide, this shows you what we believe to be the underlying drivers of returns. Now I talked to you about that, you know, the headline performance for the fund. You know, this is showing you the long-term strategy. This is showing the long-term performance as well. You know, what has driven that? What are the underlying features? Well, in our view, it's the returns of the companies themselves. It's the returns to equity. It's the returns to capital. This slide here is specifically focusing on the return to equity. I think it's an imperfect but a good measure. And you can see from the bars on the chart that our strategy in blue has comfortably exceeded that of the benchmark, done so without churning the portfolio. The point being that reinvesting earnings at these high levels or higher levels leads to faster, more sustainable growth in earnings and dividends. And I think it might come as a bit of a surprise, but given the age of AI, given the headlines about the Magnificent Seven, actually the index's earnings growth, EPS growth over this period, and this is, well, taking that 13-year track record, has only averaged about 5 to 6%. I mean, that's far from terrible, but it is not the kind of AI supercharged rate that I think some people might imagine. It's also a rate that our companies in general, being, as we think, better than the average, have been able to surpass. And it means that the returns that we've generated, that you can see up on screen, have been driven by that faster rate of growth. Now, the other interesting factor, and this is speaking again to the valuation of the market itself, but you know, the index over this period of time, so to 2011 to up to 23, 24, has very substantially re-rated. You know, the multiple has come up nearly 80%, and you know, whilst we've had a bit of that in our portfolio, it's not been to the same extent. And in our view, the underlying compounding is a far more sustainable way to produce returns than that multiple rating, which obviously can go in the other direction. Now I don't know how much more time I've got. I'm you know, actually I'm ambitious to give you guys some of your morning back, but I thought I might just take you through one more slide. Actually, if we skip this one and go on to the next one, yeah, thank you very much. Again, it's, you know, the ambition is to focus on the companies. You know, I think that is key. It's what you own that produces your returns. You know, not necessarily how you think about them. And so these two are 2 out of 3 of our top holdings. So as good as any to talk about. But I also, given the discussion, you know, from other speakers that I've alluded to earlier about technology, about AI, about the Magnificent Seven, I thought it'd be nice to highlight the fact that these two stocks, and it's LSEG, or the London Stock Exchange Group, RELX, which used to be called Reed Elsevier, you know, they are, again, holdings in the strategy since its inception, so going back to 2011. They really have rewarded our patience over time, a bit like TKO. And they've done that not with fireworks, not by tripling in any given year, but by compounding in a nice, powerful, boring way over a long, consistent period, which has led them to outperform the MSCI World, outperform the Nasdaq, certainly in LSEG's case, outperform several of the Magnificent Seven. It's what is interesting about these companies is they are not tech companies in the traditional sense. They both have incredibly long histories and heritage behind them, stretching into genuinely hundreds of years. But because of that heritage, they are in a position today where their intellectual property, where the data that they see, the content that they publish, is again, it makes them a mini monopoly. It makes them unique, and that's an extremely powerful position to be in because, their customers need them. There is no alternative. There's no substitution. They are so plumbed in that their underlying clients cannot do their jobs without LSEG's data, without RELX's data, and that builds a pretty fantastic moat. It means you've got pricing power. It means you can protect wide margins. It means you can have defensible growth over long periods of time. The academic, legal, and risk industries need RELX. Global infrastructure needs LSEG. And so, yeah, that also puts them interestingly in a pretty important position when it comes to the application and the development of new technology, because AI is a key driver for these businesses as well, given that their IP, their data can be used, can be applied, and you can see some comments on the right to emphasize that. So, Eugene, I'm gonna pause there, and hope that's fulfilled some of the brief. Happy to answer any questions if there are, but otherwise, it's been great to talk to you all. Thank you for listening.
James, thank you very much. And Little Crane, as you showed, has a phenomenal long-term track record. You've done your clients well over time. And listening to you, or Nick, it's always very humbling. You answered most of my questions with your opening comments, and very thought-provoking indeed. But maybe just a question on that. I mean, how do you resist in disturbing the model that you have in holding compounding companies? And I mean, especially if you go through a couple of tough years, how do you just keep to or stick to your guns? What is that process?
I mean, that's a truly fantastic question, because that I think is the real challenge. To sit on your hands and do nothing when the world is screaming action and activity. And obviously sometimes it is right to act, and sometimes it's really important. And I don't want to kind of give the impression that we never make any changes. I mean, we've actually made a change in the last few months to the portfolio, and we do it when we think we found a really meaningful upgrade to the positions that we hold, and we've got a strong bench as a big process around that. There's lots of research going into those companies too that we don't own, but at the end of the day, it can also be very, very easy just to lose patience, and to do that with a currently underperforming business, trapping yourself in a cycle of buying high and selling low. I don't think that is a good way to generating excess returns sustainably over a long period of time. So I think it comes down to the process that we employ. I think we are very thoughtful, not only when we're buying a new business, but also when we're considering selling an existing one. I think it's important to give as much time to both sides of the equation. And yeah, we certainly bias ourselves towards inactivity, and that works for us.
Leads me to my question, one of the questions from the audience. If your principles revolve around cash generative companies, what would need to happen to sell Shiseido, and what is your sell philosophy?
Yeah, I mean it's a great question, and it kind of follows on quite nicely, I think, because what is it that makes Shiseido, a great business? Why is it in our view better than the average company? Why would we want to hold it in the first place? I think we have to acknowledge that all companies, no matter how great they are, will go through difficult periods, and we may be lucky and not see them. But I think more than likely, if we are owning a business over a 10, 20-year time horizon, which our low turnover implies, then we're going to face some of these issues. But why do we own Shiseido in the first place? Is it for its cash generation? Ultimately, yes, over the long term. Compounding cash flows is how you create value. But the kind of the key drivers of that are the intellectual property, the brands that it's built up over more than 150 years, the market positions that it has in countries like China, where genuinely the envy of every cosmetic startup. Now, right now, it's not generating a ton of cash, but it doesn't have a horrendous balance sheet. It doesn't have. There's no signs that the brands have been permanently impaired. That they still top the rankings in terms of perception, in terms of resonance from consumers. So if we're right on all of those ingredients of Still & Praise, then we know the business can get back to generating cash. As I say, we engage with the management to see what direction they're heading in. And capital allocation can be a big part of this equation too. But that is the process. So short answer, the sell discipline is, if we think there's a much better company out there, we will sell it and buy that. But actually, it's quite hard to replace a business with that kind of heritage and that strength of brand.
The last one, looking at UK specifically, again, on a relative basis, being disappointing. You've explained a lot of that. But how do you respond to that, especially in the UK market? It's a big component of your portfolio. Do you now buy more in the UK? And where do you buy from? Do you sell non-UK holdings? How do you position?
Yeah, I mean, it is a great question. And if Nick has a really long heritage and history back, looking at UK markets specifically.
Yeah.
And he in every conversation is extremely bullish looking forwards, and that is based not necessarily on the UK economy, that is not based necessarily on politics or the UK, but it's looking at the businesses within the index, and who knows what the index goes on to do in the future. But there are some really world-class companies listed in the UK, and they are globally relevant businesses. As you say, we own a decent slug of them. LSEG is UK listed, but the majority of its revenues are global. It's its market share in derivatives clearing is like 90% globally. So yeah, I mean, I think there's one approach, which would be to try and make a call about the UK market itself. The other would be about the companies listed within it. And I think we've got some great businesses. Do we try to increase our allocation? Not to the UK, but yes, to those UK businesses where there's been share price weakness. Yeah.
James, insightful indeed. Like I said in my opening comments, you've stood your clients well over time. And times are changing, markets are changing. You've shared some great examples of companies in the UK that can actually outperform the Nasdaq, and with great cash in the businesses. There's still another open question from the audience, but I'm going to park it in the interest of time. We'll circulate that question through to you if you can maybe provide short comments. James, thank you so much.
Thank you very
Right,
much.
stepping to our last session of today on global value and being contrarian, but not just being contrarian for the sake of being contrarian. All familiar with, based in Jersey, Simon Raubenheimer from Contrarian joining us now. Simon, always great to have you on our session. Some questions often asked by the audience, does it pay to be contrarian? But if you look at your numbers, you absolutely smashed it. So interested to see what you've done that worked well 2024 and how you position for 2025.
Good morning, Eugene, and good morning to your audience. And again, thank you very much to BCI for the opportunity to speak to you all, and thank you to the audience for your time. If we hop into the next slide, maybe reading from right to left, just to remind you that we have the two offshore funds. One is an equity fund, one is a balanced fund. You can access our offshore funds, of course, directly by using your foreign allowance, or you can use the BCI platform, and then you can access our funds without having to tap into your foreign allowance. The underlying investments are identical. And then also maybe just to briefly mention that toward the end of last year, we also launched a domestic equity and a domestic balanced fund, which can invest up to 45% offshore. And those will essentially go feed into our global equity and balance strategies. And then we've also got a South African-only domestic equity fund, which will be fully invested in South African shares. But of course, the subject for today is our global funds. So let's dive in. The next slide shows the performance of our global equity fund over various time periods. And this is all to the end of January. Maybe just to say, when we underperform, it really hurts. All my money is in our funds. In fact, I'm invested in the highest fee-paying class. Now, we don't look at things top down, but given how the macro played out, be it the AI boom or the sort of continued winning streak in the US, various political developments, even sort of the economic outcomes, it feels like we kind of expected a lot of the things to play out the way they did, and yet we still didn't outperform over the last 12 months. Our absolute returns were good. In fact, 20% after fees over the last year. And as you can see, our equity fund beat the average manager, but we lagged the MSCI World Index, which did 21.4%. So we are disappointed. Over all periods, we've beaten the average manager, but over 3 and 10 years, we are still somewhat behind the MSCI World Index. The 5-year number looks very strong, and then the since inception number, of course, is one that we think is most important and remains very strong. The next slide shows a similar table, but for our balanced fund. You can see that the 10-year number, as our equity fund, the 10-year number still has the very tough 2018 to 2020 period in the base. So whilst we are above the average manager, we are still behind the index over 10 years. But for our balanced fund, the 1-year number, the 3 years, the 5 years, and the long-term since inception numbers are pretty strong. The next slide shows our top 10. Those 10 shares make up 60%, as you can see, just under 60% of our equity fund, and of course, almost 60% of the equities that we hold in our balanced fund. Now, we had some big winners last year, despite all the skepticism we got from clients around Tesla. Tesla, which is our largest stock, was actually up more than 60% in 2024. You go down that list, Meta almost doubled, Alibaba was up a bit, Block was up a bit, Amazon was up 50%. JD.com was up 20, PayPal was up 40, Fox was up 65. So we had some really good winners. But what hurt us yet again were our deep value media shares, specifically Warner Brothers and Paramount. Those shares are down now probably 80 to 90% from their peaks. Paramount was down 30% in 2024. Warner's was also down. The Paramount share price is particularly puzzling because it's subject to a merger with Skydance, in terms of which Skydance is paying you close to $15 a share for 50% of your shares. And the share price is currently trading at $10.50, and that deal is expected to close around sort of the end of, toward the middle of the year, the end of the second quarter of 2025. So not too far away. Let me quickly maybe touch on those two media businesses and just on why we haven't lost faith in those. So the next slide, I think the one very important thing for us is that these media businesses continue to produce some of the very best content that's out there in the world. And I think that is the absolute North Star for these businesses. And I think importantly, unlike, let's say, a Disney with Marvel or their Star Wars universe, many of the titles of Warner's and Paramount haven't been over-monetized. So as an example, the last standalone Superman movie was back in 2013. A new one's coming out this year. And Warner's is looking to release a new Harry Potter TV series that will run over 10 seasons, starting in 2026. So we think their content libraries are incredibly valuable. The next slide shows the current revenue composition of those two businesses. And as you can see, the blue blocks there, the legacy TV media divisions still dominate. So that's the old sort of cable TV or almost DSTV-like businesses where you have to wait for your program to air in order to watch it. So that's in blue. The streaming businesses, which are the equivalent of a Netflix-like on-demand service where you can watch what you want to watch when you want to watch it, that's in red. So that division those two divisions didn't exist a few years ago. And then the movie studios are shown in green. Now, what these businesses have grappled with is this transition of viewers away from the blue, so legacy businesses, which are currently still very profitable, and toward the red, so the streaming businesses, which are loss-making in the early years. And as viewers transition away from blue and into red, you are losing profitable revenues and substituting those with loss-making revenues, at least in the early years. The reason for the early losses in their streaming businesses are, well, firstly, you are spending money on a lot of money on advertising to attract new viewers to your platform, and you've also got early stage discounts and all sorts of incentives that you're offering to viewers to get them onto your platform. You've also got higher upfront content costs, and then you've also got the actual physical costs of establishing a brand new technology platform, so technology people and all sorts of other costs. But in the fullness of time, we think that the red streaming business, in fact, has better economics probably than the legacy blue business, because now you have a direct relationship with the end consumer, which means you can do all sorts of interesting things like send them more targeted advertising. Plus, you've cut out the middleman, so your distribution costs are a lot lower. And we believe these companies are getting close to that point. So if you look at Paramount's US business, for example, it's already post that inflection point to profitability. The last 2 quarters for their streaming business were profitable. It's still largely a US business. And the next big driver for Paramount will be to expand their streaming businesses internationally. And those are all incremental revenues, given that you're adding marginal subscribers, but your marginal costs don't go up as much, given that by far your biggest expense is your content costs, and those remain the same. So we think a lot of that drops down to your bottom line. And it's similar for Warner's. So Warner's streaming business is actually already expected to generate substantial profits this year. Management expect EBITDA, which is operating profits before depreciation and amortization, to meaningfully exceed $1 billion in 2025. So just by sort of context, the blue, so the legacy business, we expect generate around $8 billion in EBITDA, and the red will generate around $1 billion, but the red is growing quite rapidly. So on the next slide, as you would expect, we are following this transition from linear to streaming very, very closely. The 2 most important variables there are the number of streaming subscribers, which are shown in the gray bars on your left axis, and the average revenue that you get per subscriber, which is the blue line on the right. Now, if you can raise your fees and grow your number of subscribers, then that bodes very well for the future. Now, of course, we realize that it won't be linear. There will be swings and roundabouts. You have promotions from time to time, or you're launching in new international markets where fees are typically lower than in the US. But the trend, we think, is very promising. And the next slide is the same slide, but for Warner Brothers. And again, the trend is the same. The lines go from the bottom left to the top right, which we think is a very healthy sign. So on the next slide, I think that's quite interesting. Here we compare the top 6 streaming services in the US. You can see there Netflix is the clear leader. They've got sort of 302 million subscribers. And we know that Netflix's stated goal is to monetize. So in 2017, you were paying $11 a month for a premium Netflix subscription. You're now paying $25 a month. And as Netflix increases its pricing, the rest of the industry follows. Now, note how sensitive these companies are to changes in pricing, and we've put that in the paragraph below there. So if Paramount were to charge $2 more a month, so they're currently on $12.99, if they charge $2 more a month for their streaming service, it increases their revenue by $1.7 billion. And all of that flows through to your bottom line. So that's with no incremental costs. So it gives you $1.7 billion of additional pre-tax profit. Note the market cap of Paramount is only $7.5 billion. And for Warner's, it's the same. So for Warner's, you're adding $2.6 billion of additional profits every year. And this is for a $25 billion market cap company. So we think the opportunity is enormous. And we believe that in time, patient investors will be rewarded, which we think is why very astute investors like Larry and David Ellison and others are interested in these businesses. The next slide, maybe just a few comments on Tesla. A very high-level overview. I've spoken to Tesla before. So we think Tesla is between kind of two growth waves. The previous wave was driven by improvements in its model lineup. And the growth rates there sort of peaked around mid-2023. The progress was easy to measure. You could just look at the growth in the number of cars sold, which was incredible. The next wave is very different. It's about software. It's about AI. We believe Tesla's future lies in autonomous driving. It lies in robo-taxis. And further down the line, it lies in robotics. Now, Tesla has a fleet of about 2.5 million cars on the roads in the US, all equipped with cameras, many of whom continually feed data back to Tesla's supercomputer, which is custom built for self-driving. Tesla's AI-driven approach is radically different to everyone else. Tesla only uses cameras, an end-to-end neural net, and reinforcement learning that trains itself how to drive, just in the same way that us humans use our eyes and our brains. Their opposition in self-drive, so companies like Waymo, for example, still use radar, LiDAR, high-definition maps, and these maps have to be accurate to the centimeter. Their solutions are expensive, they're localized, they're hardware intensive, and they're not scalable. General Motors in December pulled the plug on Cruise, its robo-taxi business, after spending more than $10 billion on it. Tesla's challenge, of course, is that you need absurd amounts of data to make it work, and then you need a ridiculous amount of processing power in order to make sense of all this data and learn from all the video imagery that you're collecting. This is why Tesla's fleet, which I mentioned earlier, is so important. We think Tesla is the only company that has that. Tesla's lead on the competition, we also think, is now at a stage where no one can catch them anymore. And with every day that passes, Tesla's moat, or its advantage on the competition, just grows. This picture that I've put up here is actually Tesla's robo-taxi, which we expect to debut sometime around the middle of this year in Austin, Texas. And if you look very closely, you'll note that it actually doesn't have a steering wheel. It's only got a big iPad-like screen as a dashboard. So we think the future is closer than a lot of people think. The next slide just shows Tesla's data advantage. Those are the number of miles driven with full self-drive, which at the moment is still largely supervised. Tesla has, as you can see there, has driven a combined 3 billion miles already under FSD, of which 2 billion were driven using their neural net approach. So we think this is a massive competitive advantage. And the next slide, of course, shows, as I said earlier, you have to know what to do with the data and how to process it. So as you can see here, Tesla has almost 90,000 H100 equivalent GPUs to process all this data. Now, remember that one of these GPUs costs probably somewhere between $25,000 and $30,000. That's if you can get them. You can't get them. The hyperscalers have booked out NVIDIA's order book for the foreseeable future. And the next slide also just shows that as these models are learning, the cars are getting safer. self-driving is not only about convenience, it's about safety. So every year in the US, there are more than 40,000 deaths on the road. This chart here shows the number of miles driven before an accident occurs. Not a fatality, just an accident. And you can see in red there for the average driver in the US, it's around 600 to 700,000 miles. It's slightly better for the average Tesla driver. It might be that that's just because the Tesla cars are slightly newer than the average cars in the US fleet. But what's interesting to us there is the blue line, which is a Tesla car, but with autopilot engaged. And you can see there that with autopilot on, the Teslas are going like 6 million miles before an accident occurs. So that's like 8 or 9 times safer. It's an order of magnitude safer than a normal car. Now, note it's still not perfect. There still are accidents, but it's getting better every single year. This is not pie in the sky stuff. This is an incredible real life use case of AI that is currently happening in front of our very eyes. And we believe fully autonomous driving in the US is a lot closer than people think. I've got one more slide, and I'll maybe end on this. So you'll recall that historically we've been very bullish on the US. This slide is just to highlight that we are finding increasing value outside of the US. So for the first time in a long time, we're actually now underweight the US. And as you can see there, our allocation to Europe has gone up substantially. And if you go lower down, you'll see that we are very overweight China. So that's the direction of travel. And in time, hopefully, we can talk to you about some of those global shares that we're finding very attractive. But I'll maybe end it there. And just to thank you again for the opportunity to present and to spend some time with you all. And of course, if there are any questions, please don't hesitate to reach out to BCI or to myself directly, and we'll do our best to answer those.
Simon, I'm going to be naughty. We're very much out of time, but there's some very interesting questions coming in from the audience, and I'm going to take a few of those. Just on Tesla, I mean, Dan from Excel Academy, who drives our session at the back, shared a very interesting picture this morning of stickers of Tesla selling like mad on Amazon, and the stickers reads saying,
Be nice.
Tesla before Elon went mad. But I mean, on that, and I mean, a couple of companies or investment management companies holding big holdings in Tesla. ARK Invest, also one of them, similar to you. But the Tesla price is slipping very quickly. Is it getting too distracted? What do we read into that? Or is it a case of competition increasing globally in the EV and AV market?
Tesla is a very polarizing share. People have incredibly strong opinions sort of both ways. It's also a very heavily shorted share in the US. So a lot of hedge funds are short Tesla and long a basket of deep value like BWs, and the automakers are on 2 or 3 times earnings. There is a lot of news. I think to us, and there's a lot of noise. I think to us, what are the important things? The important things are, firstly, is the company under financial pressure? No, they're actually very profitable. Is Elon still the CEO? Yes, he is. Is the Tesla team still executing? They're executing very well. Are their products world-class? Yes, they are. And does Tesla still have the lead in real-world AI and robotics? And that to us is important. And then, as I say, we are following the progress on AI and autonomous driving and robotaxis very closely. I think the rest of it, the quarterly sales numbers and all those things, don't sort of bother us all that much, provided the company's on the right track. Now, we do look at the competition a lot, and we think the only companies that could potentially compete with Tesla are the Chinese. And we saw yesterday BYD announcing again, progress on their autonomous driving efforts, and they're actually throwing in a lot of software with new cars for free. That said, I don't think US regulators would allow millions and millions of road users to be autonomously driven by Chinese software. So we just don't think that's going to happen. In the same way that it's probably in the fullness of time, Tesla software won't be driving Chinese companies in China. So we think there'll be a Western sort of model and one used in China. And that's, I think, the way things will unfold. But we think so long as those 5 things I mentioned earlier, I think so long as those are all intact, I think we're pretty happy with the way things are progressing, irrespective of the volatility in the share price. There's a lot of noise in the short term there.
Mining a fan very clearly. Maybe you've answered a couple of questions on Tesla that came in, but another one from the audience, I think very interesting. Everybody wants to know, where are we in the global cycle of growth versus value? And in a US exceptionalism period with Trump trade wars and limited or stalled interest rate reduction cycle, how does this bode for value as a style?
I mean, for most of Contreras' history, so we started in 2009, growth has beaten value, hands down. I mean, the growth index has outperformed the value index massively. That wasn't the case before. So if we took the 10 or 15 years before Contreras launched, value was well ahead of growth. So I think if you look at the valuation disparity now between sort of classic value and classic growth, there's a very strong case to be made that the next 15 or whatever, 10 or 15 years could be better for value. And we are seeing that. So if that final slide I showed on where we're seeing value around the world, a lot of those are in more traditional type sectors. And I think that might be the direction of travel going forward. That said, I mean, AI and all these things, there are some very interesting technologies coming out, and one has to be very careful because a lot of traditional value sectors will get disrupted over the next few years. And there are a lot of things that I think look cheap, but actually won't turn out to be cheap if you look 5 or 6 years down the line. So you have to tread very carefully. But as a broad top-down sort of view, I think there is a good case to be made that the future is looking good for value. I mean, there are a lot of great companies, in fact, high-quality businesses that aren't growing rapidly, but that generate high returns on equity that we think are now trading at very reasonable prices.
And I mean, you made the point there, exactly that. Value doesn't mean you just keep on buying cheap stuff. You buy quality companies where they are good ROE, but just maybe trading at lower valuations than some of the big counters. It's exactly that.
Yeah.
Simon, thank you so much again for coming on to our session. It's always great to have you with us and continue the good work you're doing for our clients.
Thank you very much, Gene.
We're grateful.
Thank you so much. Cheers.
And with that, I'm going to close.
Bye-bye. Bye-bye.
Thank you so much. Thank you for patience in staying a little bit longer, but I think it was insightful. Big thank you to all our presenters of the day. You've done a terrific job for making for good content. But most of all, to our audience out there, thank you so much for your continued support. Ultimately, this is all about you. Any information you want, get hold of the BCI team. We can get you in contact with any of the fund managers. And like I mentioned in the opening, we will be sharing the recordings of all the presentations on the Boutique Managers website. To Olga, Tanya, the BCI team, Dan from Excel Academy, thank you so much. Keep a lookout next week. Live roadshows starting the 18th of February, starting in Durban. Then we're going right through the country, finishing in Bloemfontein on the 4th of March. And we look forward to seeing all of you at the live sessions, and have a great week further. Thank you so much.